Hello, this is part 2 of a video where I'm trying to explain to you how to conduct a financial analysis. And in part 1, I calculated all the ratios and explained the connection. And now in this part, I will try to show you what comments are you supposed to do. And here you can see there is profitability, there is earnings capacity, and solvency and liquidity. And here I will show you the first part is the profitability. And you should include everything I have written here when you're doing your comments. The first part in the profitability is the most important ratio, return on capital employed. You should tell if it has decreased or increased, and the level compared to the market interest plus risk premium for running a business. So it should be at least at 7%. In this case, it is 17, so it's very good. And then you split up, as I told you in the first part, in operating margin. That means earnings capacity and rate of asset turnover. And in this case, the operating margin has decreased from 37 to 34, and it has a negative effect, and that's it. Rate of asset turnover, it is the revenue related to the assets, because an important part of running an efficient business is to make a high revenue related to your assets. The smaller amount of assets you can invest and make the same revenue, the better. So make a comment on this as well. It has, in this case, it has decreased. That has a negative effect on return on capital employed. Then the return on equity, and you have to explain what I said in part number 1. It decreases because the return on capital employed decreases, but it's closely related to return on capital employed, but also to cost of debt. Because if you can take a loan on 1%, and that is your percentage here in this company, and you can invest the money in your company and have a return on capital employed on 17, you are making a rather good profit working with debt. So take a cheap loan, 1%, invest in the company 17%, and you will have a small profit that will be added to your equity. And therefore, your equity return on equity is higher than your return on capital employed. And then the same story again here, because the debt ratio is has decreased, and that is of course positive. And then again the story of if your interest rate on your debt is smaller than your return on capital employed, it's a good idea to take a loan and invest in the company, and then you will increase your return on equity. The gearing is almost the same in this company, and the gearing is your debt divided by your equity, and in this case your debt is 50% higher than your equity, and it is okay. The next part is the earnings capacity, and as I told in part 1, the profitability, you have it here, and one of these in the first triangle, return on capital employed, operating margin, and rate on asset turnover. These three are related, and this operating margin, you take this out of your profitability, you could say, and make here a special analysis of the earnings capacity. And as you can see here, they start again with the earnings capacity. The operating margin has decreased from 37 to 34. Same story as you told here in the profitability. And then you try to investigate in this, how could this happen? And one of the reasons is that your gross margin decreased. it is a bad thing that your variable cost increased more than your revenue. So therefore you have a decrease on your gross profit margin. And on top of this, you can see here that all your costs increased, your fixed cost increased more than your net sales, your revenue. So therefore you have a negative effect on your operating margin because of the increasing fixed costs. So now you know what happened to their earnings capacity. A negative effect on the relation between sales and cost of goods sold or variable cost, and a negative effect because the fixed cost increased more than your sales. So the sub-conclusion on profitability and earnings capacity is the following. The most important ratio, return on capital employed, has decreased by 12%. This decrease in profitability is caused by a decrease both in earnings capacity and their ability to adjust assets. But you can see here 7% is related to the earnings capacity and 5% to the relation between revenue and assets. So the most important thing is that the operating margin decreased. And then only two things more. Solvency ratio, it is around 40%. It's very good because normally we say between 30 and 40%. It's an acceptable level. If it is below 20%, if the equity is less than 20% of the total assets, the banks will be afraid, and it is a problem. And the good thing by having this rather high solvency ratio is that we are able to survive even if we have some losses in the future. This company is rather solid. The liquidity ratio, it is 107. It is in fact not enough because when we relate and this is the story about current assets that should exceed the current liabilities, because we cannot pay our current liabilities if we do not have a money inflow coming from first stock and then receivables. So it should be the perfect level is at least 150%, and we are not there. We are only on 117, so it's a problem. And then the total conclusion. The analysis shows that the company is doing quite well. The profitability is very good, and of course it's a problem that it's decreasing, but it's still far above the acceptable level of 7 to 8%. And the reason is that for this decrease is that earnings capacity decreases, and also the capital adjustment. The solvency is good, which means that the company can survive. The liquidity is not so good. It should be improved. A level about 150 is optimal. But because the company is overall healthy with high return on capital employed and high solvency, it should not be a problem to get a long-term loan, and therefore you could decrease your current liabilities and obtain this long-term loan, and then you will have no problem anymore. So read these comments carefully, and that you should include all of the things I have written here.